Hello, friends. There's a single Social Security decision that can cut your monthly check by about 30%. And it is permanent. No do-over. Most people only find out long after the money is already gone. If you were born before 1966 and you are already getting a Social Security check, or you are about to file for it soon, this is the one video you do not want to scroll past today. Some of you watching have already made that exact decision and you do not even know it just yet. But here is the good news. If you catch it in time, most of these mistakes are completely fixable. And in the next few minutes, I am going to show you exactly how to check your own situation today. Here is the part that quietly keeps people up at night, the thing nobody ever explains them in time. When you claim your Social Security early, your monthly check gets cut, and that part is very simple. And almost everyone believes the very same comforting thing about that new and smaller monthly check. They think that once they reach full retirement age, it climbs right back up to the full amount again. So they wait, and that hopeful bump back up to full never actually happens for them. Because there are two completely different reductions hidden inside the whole Social Security system. And here's the real trap. Only one of those two separate reductions ever truly comes back to you. Mix the two of them up, and you can spend the rest of your life on a needlessly much smaller check. By the end of this, you will know which reduction is permanent, which one returns, and what to do. So stick with me, because the most important number in your retirement is not 65 at all here. And it is not a simple round 67 either, the way that most people watching just assume it is. It is a specific month and year that belongs to you and to you alone, and truly to nobody else. Most people have honestly never once been told what that single personal number actually is for them. I will give you the exact and simple way to find yours before this whole video is completely finished. I am not here to read you a dry government pamphlet or bury you in confusing official legal language. The reason these mistakes happen is not that people are careless or that they do not pay attention. It is that when the rules change, the Social Security Administration does not personally explain it. They quietly update the policy and then they simply assume that you already know all about it now. What I do is take the 2026 rules and translate them into plain, everyday, honest English. If this is the clear explanation you wish you had 10 years ago, subscribe and stay close with me. These rules shift every single year, and the people who hear it in time are the ones who can act. And do me one quick favor while you are here, drop your birth year down in the comments below now. Before this video is over, you will match it to your exact full retirement age, right down to month. We start with something that most people watching have honestly never even heard about before today. If you have already passed full retirement age and still have not filed, then listen closely to this. You can request up to 6 months of retroactive Social Security payments in one single lump sum check. They pay you as if you had applied up to 6 months earlier, all at once with your very first check. But here is the trade-off, and it truly matters. Your ongoing monthly amount is then set a bit lower. It is not free money that appears from nowhere. It is simply a timing choice that you alone are making. The option quietly exists on the books, and yet almost nobody ever thinks to actually ask them for it. Keep one thing in mind as we go. Only one of these 6 mistakes can ever be fully reversed later on. Before I show you the next 5, let me be straight with you for just a moment because it matters. This video is made for Americans already receiving Social Security, or getting close to claiming it now. The goal is simply to help you understand the rules so you avoid a decision you truly cannot reverse. Everything here comes from public official information that you can look up and verify for yourself. It comes from the Social Security Administration and the official Medicare website, all named as we go. This is educational content only. It is not personalized financial, tax, or legal advice for your case. And nothing here is a promise that you will personally receive any one single specific amount of money. Everyone's situation is different, so before any big decision, talk to a licensed professional first. All right, with all of that said clearly, now let us get straight into the next one on our list today. Next up is Medicare, and this one quietly costs a lot of people far more than it ever really should. Most people in 2026 pay the standard Part B premium of about $200 a month. But if your income 2 years ago crossed a certain threshold, you then pay an extra monthly surcharge. That threshold is more than $109,000 for a single person who is filing alone. Here is the trap that surcharge is based on your income from 2 full years in the past and not now. So, a one-time event like selling a house can quietly push you up into a much higher bracket by surprise. It can happen even after your income has already dropped right back down to its normal level once again. Pause this video and write this part down because it can quietly save you real money this single year. If that is you, the appeal form is the SSA-44, made for income that fell after a life event. People overpay for a full year simply because they never once knew that one appeal form even existed. This next one is for anyone watching right now who has lost a husband or a wife somewhere along the way. A surviving spouse can receive a survivor benefit worth up to all of what the late spouse was receiving. In a lot of cases, that amount is meaningfully higher than the benefit on your own personal work record. But the Social Security Administration does not automatically move you onto the larger one of the two. You often have to specifically ask them to compare both and then to put you on the higher amount of it. And let me gently ask you something right here, because it is truly the heart of this entire video today. Did you assume that early benefits simply bounce back up at your full retirement age sometime later on? If so, you are truly not alone in that at all, and that is exactly the confusion we are about to fix. Let me make this real for you with a simple, everyday story that you just might recognize yourself in. Margaret, and this is an illustrative composite, is 63 years old and recently widowed in Ohio. She lives on a single monthly check, and at 62 she claimed early scared of waiting far too long. Like almost everyone, she assumed her check would climb back to full once she hit full retirement age. It will not. That early claiming cut she locked in at 62 is now permanent for the rest of life. What Margaret did not realize is that as a widow, she may well qualify for a higher survivor benefit too, but only if she actually asks them to compare the two amounts for her and then switch her over to it. Two completely different rules, one of them she can never undo, and one of them she still very much can. Now, here is the one that is the exact opposite of what you just heard, so please do listen very closely. If you are still working while collecting before full retirement age, there is a yearly earnings limit. For 2026, that earnings limit is $24,480 a year. Earn above that limit and they withhold $1 in benefits for every $2 that you go over. And this is exactly where people quietly panic because they think that money is now simply gone forever. It is not gone at all. Unlike the early claiming cut, this withheld money is not actually lost to you. It is credited right back to you once you finally reach your own full retirement age further down the line. That is the reduction that returns to you. The early claiming cut is the one that simply never does. Same single word reduction, and yet two completely different outcomes for your money and for your life. Before, the big one here is a quiet mistake that hides for decades inside your own personal work history. Your benefit is calculated from a lifetime of earnings recorded all the way back to your very first job. Every single year was one more chance for some small thing to quietly go wrong inside that work record. A wrong figure submitted a year that went missing or self-employment that never got reported correctly. If you worked through the 1980s and 90s, the era of manual payroll, then check closely. There is a real chance at least 1 year is off, and each bad year can quietly lower your monthly benefit. Open your personal Social Security account, pull up your statement, and compare it against your records. Do it while you still have the paperwork, because those old documents get harder to find every year. And here is the number that everything else depends on, the one that I promised you at the very start. Your full retirement age is not a simple round 65 or 67 for most of you watching this. If you were born from 1960 onward, it is exactly 67 clean and simple for all of you. But for the in-between group, it shifts by birth, year, month by month, and this part really does matter. Born in 1955, it is 66 and 2 months. In 56, 66 and 4 months. Born in 57, 66 and 6 months. In 58, it is 66 and 8 months exactly. And if you were born in 1959, your number is 66 and 10 months, not a year more. That is your number down to the exact month, and it quietly controls every single decision after it. Now here's the simple truth that finally closes the loop we first opened at the very start of this video. Claiming at 62 when your full retirement age is 67 cuts your benefit by about 30%. And that particular cut is permanent. It does not climb back up at your full retirement age, not ever. That is the reduction people confuse with the earnings test money, and that one confusion truly costs them. It quietly locks so many good people into a much smaller check for the entire rest of their whole lives. But there is a real upside waiting on the other side of that very same important personal number too. For every month you wait past full retirement age, they add delayed credits right up until age 70. Wait the full stretch, and you can receive up to about 24% more every month for life. Same person and the same work record. The only real variable is understanding this one number fully. So, let us quickly count it all down together, now one clear mistake at a time, before you go today. The 6-month retroactive lump sum is a timing choice, not free money, so weigh it all very carefully. The earnings test withholds your money for a while, but then it pays it right back at retirement age. An IRMAA surcharge from a one-time income spike can be appealed using that same SSA-44 form. Your full retirement age is specific to your birth month, and the early claiming cut stays permanent. A widow or widower should always ask to be compared to the higher survivor benefit amount available now. And check your earnings record now today while the fix is still completely free for you to go make. So here is exactly what to do next in 3 simple and clear steps you can start on this very week. First, open your personal Social Security account and pull up your full statement sometime this week. Second, find your exact full retirement age by your birth month and verify your record year by year. Third, before you make or change any claiming decision, confirm the details on the official sites first. And sit down with a licensed professional because decisions like this one are genuinely hard to undo. If someone you love was born before 1966, a parent or a neighbor, please go and send this. The reduction that never comes back is the one that nobody warns them about until it is far too late. And that earnings record we talked about earlier, fixing it honestly deserves its own full walkthrough. That is the next video, step by step, where I will walk you through the whole correction process slowly. I will see you right there in the next one. Take care, and please go check your own number today, okay?